Welcome to The Explainer. Today we're diving into a massive, frankly fascinating shift in the macroeconomic landscape. We're breaking down a source that details Strategy's revolutionary approach to structured finance, and really how they're engineering a complete transition into a new era of digital assets. If you've been tracking institutional fund management lately, you know the ground is literally shifting beneath legacy benchmarks. So let's jump right in and visualize exactly how this is all playing out.
Now take a look at this quote. Digital credit is like the kerosene of finance. It is the universal monetary fuel. That is a bold, bold statement straight from Strategy's recent earnings call. I mean, calling something the kerosene of finance, that's huge. What they're talking about here is digital credit, specifically a totally new class of financial instruments backed by Bitcoin. We're going to unpack exactly how they take a highly volatile digital asset and distill it down into a universal, low-volatility monetary fuel. It's an approach that's aiming to completely redefine how institutional portfolios generate yield.
So here's our roadmap for today. We'll hit the obsolescence of traditional bonds, Bitcoin is thermodynamic energy, STRC is the kerosene of finance, escaping the yield trap, building the yield curve, and finally, the terminal sovereignty portfolio. Let's get to it.
Number 1. The obsolescence of traditional bonds.
To really wrap our heads around this, we've got to look at a real-world audit of a terminal sovereignty portfolio. This is a portfolio explicitly designed to outpace fiat inflation. And looking at the data, long-duration treasury exposure, like the ETF TLW, has basically become a relic. It makes up a tiny, negligible 0.14% of the holdings. The source argues that for an aggressive investor with a long time horizon, legacy debt that's being constantly burdened by sovereign inflation is just, well, it's the wrong asset class. Instead, it's being entirely replaced by digital credit. Think of it as a scalable, homogeneous asset backed directly by hard digital capital. The source actually frames this in a super philosophical way. Traditionally, gold was held out of fear, right? Fear of system collapse. But this new digital credit, backed by Bitcoin, it's accumulated as hope. Hope for an entropy-defying, growth-focused future.
Moving on to Section 2, Bitcoin as thermodynamic energy.
You see, Strategy doesn't just look at Bitcoin as a currency. They see it as raw economic energy. Let that sink in. The Bitcoin network is powered by this massive 700 exahashes per second. That's essentially a measurement of the sheer, colossal computing power and thermodynamic work securing the entire network. Now translate that into financial terms. What you get is an asset class with roughly a 40 volatility, meaning, yeah, it has massive price swings, but it also brings a historical 40% annualized return rate. It is raw, untamed economic energy. The problem? Raw energy is incredibly hard for traditional buttoned-up institutions to hold.
Which brings us to Part 3, STRC, the kerosene of finance.
So how do you tame that energy? They use what they conceptually call a crypto reactor. It's kind of like cracking crude oil in a refinery. Strategy takes that raw Bitcoin, sitting right around 34 volatility and a 39% annualized return rate, and they split it right down the middle. On one side, they create amplified digital equity, which is their common stock MSTR. That side absorbs the risk, pushing up to 71 volatility for maximum growth. But on the other side, they distill out STRC. This is their digital credit. It is highly refined, they strip away the currency risk, they compress the duration risk, and what you're left with is an incredibly stable 3 volatility asset with an 11.5% yield. It's pure, unadulterated financial kerosene.
And the absolute linchpin of this entire operation is this one specific metric, the Bitcoin break-even annualized return rate. Right now, it's sitting at 2.27%.
That number perfectly illustrates the sheer mathematical durability of this digital credit engine. Since Strategy uses this credit to buy more Bitcoin, the math works out so that as long as Bitcoin appreciates at just roughly 2.3% a year, they can fund their 11.5% STRC dividends forever. Literally forever, without ever having to sell a single share of stock. And get this, even if Bitcoin's price goes completely flat, 0% growth forever, the source's model suggests they still have 43 years of dividend coverage. The audit points to this as just a staggering level of collateral strength.
All right, Section 4, Escaping the Yield Trap.
Now, that portfolio audit we talked about earlier, it issues a pretty stark warning about what it calls the yield trap. The source points specifically to chasing the plasma yield engine of covered call ETFs. You know, the ones, they advertise these eye-popping yields like 60 to 120%. But look underneath that shiny surface, and you find massive price decay. Just as an example, the principal value of MSTY dropped 77.7% in a single year. Seriously, almost 80%. These products cap your upside during bull markets. They are not true wealth compounders. They're basically just volatility harvesting hedges that slowly eat away at your cost basis and trap your capital in totally inefficient vehicles.
Section 5. Building the yield curve. Because STRC acts as a foundational layer, again yielding 11.5% with a super low 3 volatility, it actually allows innovators across the market to build totally customized risk-return profiles. For example, a financial institution could take STRC, completely strip away that remaining volatility down to 0, and create a perfectly stable digital money that still yields 8%. Or an aggressive fund manager could take that same credit, leverage it 3-to-1, and build a high-yield digital fund targeting 25 to 35% returns. STRC is literally the fuel that makes all these new financial products possible.
And finally, Section 6, the Terminal Sovereignty Portfolio. The data from the portfolio audit reveals a really interesting hidden reality for a lot of investors out there. It shows a hidden Bitcoin beta of 0.79. What does that mean? It means the portfolio's movements are 79% correlated to Bitcoin. Because this particular investor held a mix of Strategy's preferred shares, MSTR derivative ETFs, and Bitcoin miners, a massive 59% of their total portfolio was synthetically moving right alongside Bitcoin. And the crazy part? They only held about $6 in direct spot Bitcoin. The audit argues this proves the investor's core thesis, which is migrating to digital assets is mathematically present, even if the way they executed it was incredibly leaky and fragmented.
When we zoom in on the numbers from the audit, we see a massive portfolio concentration. The investor is holding a tiny 1.9% in Strategy's common stock, but they hold a whopping 26.4% in Strategy's preferred shares, which are exactly those bond-like digital credit instruments we've been talking about.
So what does this actually mean for you as an allocator? Well, it's critical. STRC is powerful, absolutely, but holding over a quarter of your portfolio in it, that stacks up some serious risks. First, you're taking on single-issuer credit risk. Second, you're exposed to Bitcoin tail risk. That means if Bitcoin drops more than 40%, those preferred shares can sell off violently. And third, there's dilution risk, because Strategize might just issue more preferred shares to go out and buy more Bitcoin. To fix this, the audit recommends a balanced rotation. Basically, strip away the inefficient yield traps and rotate directly into spot exposure. That way, you ensure you're capturing the full upside of a bull market without all that structural drag weighing you down.
So take a hard look at your own allocations, because as macroeconomic forces continue to put massive strain on legacy fiat systems, you really have to ask yourself, are you truly prepared for the rotation into thermodynamic-backed assets? Are you still clinging to the fixed income supernova of the past, or are you ready to fuel your wealth with digital kerosene? It is a fundamental, ground-up shift in structured finance, and truly understanding these mechanics is the only way to outpace the benchmarks of tomorrow. Thanks for hanging out with me for this explainer, and I'll catch you next time.